Most people assume that when the world goes to war, the stock market should collapse. It feels obvious, right? Bombs drop, economies shut down, fear spreads, and investors run for safety. But what if I told you that some of the biggest wars in history didn't destroy the stock market? They actually helped it grow. That's the paradox no one talks about. Because while headlines scream chaos, the market quietly follows a different script. One driven not by emotion, but by expectations, capital flows, and cold, calculated strategy. So today, we're going to unpack a question that sounds simple, but reveals a deep truth about money, power, and human behavior. What really happens to the stock market during world wars, and what does history actually reveal? To understand this, you have to shift your mindset from how people think to how markets think. The market isn't a moral system. It doesn't care about human suffering or geopolitical tension. It's a forward-looking machine that constantly tries to price in the future. Investors aren't reacting to what's happening today, they're reacting to what they believe will happen next. That's why sometimes, even during the darkest moments in history, stock markets don't just survive, they rise. Because by the time war officially begins, the market has often already digested the fear. Take World War I as an example. When the war broke out in 1914, the New York Stock Exchange actually shut down for several months. That alone tells you how unprepared financial systems were at the time. When markets reopened, there was initial volatility, but something surprising happened over the next few years. As the United States ramped up industrial production to support the war effort, companies began to grow. Steel, manufacturing, transportation, these sectors exploded with demand. War spending acted like a massive stimulus package. Government money flowed into the economy, businesses expanded, and employment increased. So while the world was at war, certain parts of the economy were booming, and the market reflected that. Now let's fast forward to World War II, one of the most devastating conflicts in human history. You would expect the stock market to crash and stay down for years, but the reality is more nuanced. When the war officially began in 1939, markets did fall initially due to uncertainty. But as the war progressed, something interesting happened again. The US economy transformed into a production powerhouse. Factories shifted from consumer goods to military equipment. Unemployment dropped dramatically. GDP surged. The government spent enormous amounts of money to support the war effort, and that spending didn't just disappear.